Right now, 2.86 million landlords operate as individuals across the UK, and most of them leave thousands of pounds on the table every year in legitimate tax savings. This video covers what you can actually do completely within the law to cut those costs and keep more of what you earn. If you're a basic rate taxpayer, here's something most people don't realise. You're in a genuinely stronger position than higher rate landlords. Since 2020, Section 24 mortgage interest rules have crushed higher rate landlords. For basic rate taxpayers, the maths work fundamentally differently, and you're holding an advantage that virtually no one talks about. Combine that with the full scope of deductible expenses most landlords overlook entirely, and you can substantially lift your bottom line. What follows is exactly how that system works, what you're entitled to claim, and what's shifting that needs your attention now. Before we break this down any further, if you want to understand the hidden policy shifts reshaping your finances and property wealth, go ahead and gently tap that subscribe button now. Property Brief UK provides clear, timely insights and summaries that keep you one step ahead. Okay, one more thing before we go any further. I just want to reiterate that we are not offering any financial advice. We have simply done the research and are summarizing our findings. Please seek proper advice before following up on any of the strategies outlined in this video. And please, never actively try to avoid paying tax. Everything you do in this area needs to be legitimate and above board. Right, with that being said, let's get into the detail. Section 24 of the Finance Act 2015 sits at the center of this entire discussion, and it's probably the thing you've heard most doom about if you pay any attention to property forums. For higher rate taxpayers, that doom is justified, but for basic rate taxpayers, everything changes. Here's the mechanism. Mortgage interest stopped being directly deductible from rental income back in April 2020. What replaced it? A 20% basic rate tax credit on finance costs. Say you're looking at £15,000 in rental income and £5,000 in mortgage interest. Before Section 24, your taxable profit would have been £10,000, taxed at 20%, which equals £2,000. After Section 24, taxable profit sits at £15,000, that's £3,000 in tax, but you claim a £1,000 credit, which is 20% of that mortgage interest. £3,000 minus £1,000 equals £2,000, exactly the same result. That equivalence only holds for basic rate taxpayers because the credit matches your tax rate. A 40% taxpayer gets 20% relief against 40% tax. And that gap is where the real pain happens, which is precisely why higher rate landlords have been exiting the market in enormous numbers. Now here's the critical bit. That advantage evaporates the moment your combined income, employment, self-employment, rental from multiple properties, everything crosses £50,270. That threshold marks the boundary between basic and higher rate. Once you breach it, any income above that point gets taxed at 40%, and suddenly that 20% credit covers only half of what you owe on mortgage interest. Finance costs total £9.05 billion in claimed deductions across the sector, representing 31% of all landlord expenses. 40.6% of landlords claim them. This isn't niche. It drives how most landlords operate. The credit covers mortgage interest, loan interest for property purchases, loan interest for furnishings, overdraft interest, arrangement fees, and any incidental borrowing costs. What most landlords completely overlook, mortgage interest is just the opening move. There's an entire landscape of deductible expenses that reduce your taxable profit, and the vast majority of landlords leave substantial money on the table because they don't know what qualifies. Start with property running costs, water rates, council tax when you're paying it, utilities that are landlord provided, buildings and contents insurance, landlord liability policies, ground rent and service charges on leasehold properties, all deductible. Professional fees represent another major category where landlords systematically underclaim. Letting agent fees are deductible. Accountant costs for your tax return, legal fees, If you're renewing a lease under 50 years, surveyor fees, all deductible. Every professional service connected to running your rental business comes straight off your taxable profit. Travel expenses represent the single most overlooked category, and this is where landlords leave thousands unclaimed. You can claim 45 pence per mile for the first 10,000 business miles in a tax year, then 25 pence thereafter. What counts as business miles? Journeys from your home to rental properties for inspections, repair visits, tenant meetings, or meeting with agents. If you own multiple properties and visit them regularly, you could clock thousands of miles annually. At 45 pence per mile, that's potentially £4,500 or more in deductible expenses. Most landlords claim nothing. Marketing and administration count too. Tenant advertising, business phone calls related to properties, stationery, and the business proportion of your broadband all qualify. HMRC applies the test wholly and exclusively for the rental business, which means any personal element disqualifies the expense. But if you're genuinely incurring these costs for your business, you should be claiming them. Things that don't qualify broadly fit under the category of capital improvements. This includes the capital element of your mortgage payment. Only the interest qualifies. Other non-qualifying costs include personal expenses, your own labour time, initial furnishing before a tenant's first day, and any fines or penalties received. This distinction between repairs, which are deductible, and improvements, which are capital expenditure and not deductible, is where landlords collide with HMRC. Does the work restore an asset to its original condition or enhance it beyond that? Replacing a broken boiler with an identical replacement is a repair. Installing central heating where none existed is an improvement. But we're not living in 1985 anymore. When you replace single glazed windows, you replace them with double glazing because that's the modern standard. That's a repair using contemporary materials. Same logic applies to lead pipes. You're replacing them with copper or plastic, which is the modern equivalent. HMRC accepts this. The entire cost remains deductible. Things get grey when improvement is incidental to necessary repair. Storm damage hits your roof and the contractor says, "While we're here, we could upgrade the insulation." You approve it. The entire cost stays deductible because the improvement was necessary to complete the repair. Pre-letting expenses don't receive this treatment. You buy a run-down property and spend money on decoration, carpeting, and refurbishment before tenants move in. That's capital expenditure. It doesn't count as repairs because you're preparing the property for first use. There's a 7-year look-back window though. Expenses incurred up to 7 years before the property was first let can sometimes qualify. Advertising costs, agent fees, and actual repairs to bring a property into lettable condition might qualify under this provision. The safest way to look at it is to ask whether the work restores something to working order or makes something new or better. If it's restoration, it's a repair. If it's creating something new, it's capital expenditure. Available since April 2016, the replacement of domestic items relief sits on the statute books specifically for landlords, and most people miss it entirely. It applies to furnished, part-furnished, and unfurnished properties. What qualifies? Movable furniture, beds, sofas, tables, wardrobes. Furnishings, curtains, carpets, linens. Household appliances, fridges, washing machines, cookers, televisions, kitchenware. The operative word is replacement. You cannot claim the initial purchase when you first furnish a property, but when a sofa wears out after years of tenant use and you buy a new one, that replacement gets claimed. 4 conditions must all be satisfied. Your business includes letting a dwelling. The claim covers replacement, not initial purchase. The new item exists for exclusive tenant use, and the old item no longer remains available to the tenant. How you calculate the claim works straightforwardly. You take the cost of the replacement item or the cost of the nearest modern equivalent if upgrading, add incidental costs like delivery, disposal, and installation, then subtract any proceeds from selling or trading in the old item. Trade an old fridge in for £100 toward an £800 replacement. You claim £700. If upgrading from a standard sofa to a sofa bed, because the equivalent sofa costs £400, but a sofa bed costs £550, you can only claim £400. One important caveat: fitted items, baths, toilets, boilers, integrated kitchen appliances, built-in wardrobes fall under repair rules instead. But the movable stuff, which comprises the vast majority of any furnished property's contents, qualifies directly. Let's look at some other available options and take a look at some upcoming changes. The £1,000 property allowance, available since April 2017, offers a simpler alternative to claiming actual expenses. If your gross rental income sits at £1,000 or less, no tax return requirement exists. If you exceed £1,000, you can claim either actual expenses or a flat £1,000 deduction. Most landlords find actual expenses exceed £1,000 annually, but certain situations break the other way. More importantly, it eliminates meticulous record keeping. Spousal income splitting. Using Form 17 matters if you're married or in civil partnership. Jointly owned properties default to 50-50 taxation regardless of actual ownership. If you hold unequal beneficial ownership, you can file Form 17 and get taxed according to actual ownership instead. If one spouse earns significantly more and approaches higher rate territory, you could structure the property ownership primarily in the name of the lower earner. You'd need a deed of trust documenting that ownership. If purchasing new or refinancing, you could structure ownership at 80-20 or 90-10 in favour of the lower earner. That means 80% or 90% of rental income gets taxed at 20%. Additionally, marriage allowance offers a separate opportunity. If one spouse earns under £12,570, they can transfer up to £1,260 of unused allowance to the other, saving up to £252 annually. October 2024's budget brought several changes. Stamp duty on additional properties climbed from 3% to 5%, effective 31st October 2024. A £300,000 purchase now costs £17,500 in stamp duty instead of £11,500. From 1st April 2025, the nil rate threshold drops from £250,000 to £125,000, adding another £2,500. Capital gains tax on residential properties stayed at 18% for basic rate, but the annual exemption dropped from £12,300 to £3,000. Income tax thresholds have been frozen until April 2031. Your personal allowance stays at £12,570. The basic rate limit remains at £50,270. This creates fiscal drag as inflation pushes more income into higher bands. The government estimates this will bring 700,000 additional people into income tax by 2031. Two major changes are reshaping landlord operations. The Renters' Rights Act 2025 becomes active 1st May 2026. Section 21. No-fault evictions disappear entirely. Every eviction now requires Section 8 grounds with legally specified reasons. Assured short-hold tenancies convert to rolling periodic tenancies by default. Tenants gain the explicit right to keep pets unless you establish reasonable grounds to refuse. Rental bidding becomes prohibited. Advance rent payment gets capped at 1 month. A mandatory private rented sector database and private landlord ombudsman launch in late 2026. On top of that, Making Tax Digital is expanding to landlords. From April 2026, any landlord with income exceeding £50,000 must file digitally using quarterly submissions through HMRC approved software. From April 2027, that threshold drops to £30,000. This requirement isn't optional, it's mandatory. Additionally, ongoing consultation covers EPC requirements for rental properties. The current baseline sits at Band E minimum. Government proposals suggest Band C minimum by 2028 for new tenancies and 2030 for all tenancies. Average upgrade costs to Band C run at approximately £6,864 according to government data. Let's consolidate what this means in practical terms. You came looking for how to reduce costs as a basic rate taxpayer, and here sits the framework for doing exactly that. First, understand your actual advantage. You hold a better position than higher rate landlords on Section 24. That 20% credit matches your tax rate perfectly, but that advantage only exists if you stay below £50,270 in total income. Cross that threshold and everything changes fundamentally. Second, claim every deduction you're entitled to claim. Most landlords aren't claiming travel expenses. Most aren't maximising professional fees. Most aren't using replacement of domestic items, relief systematically. These aren't exotic strategies, they're standard deductions that HMRC expects you to claim. Third, distinguish properly between repairs and improvements. Modern materials and like-for-like replacements all count as repairs. Capital expenditure doesn't qualify. Get it right, and you save substantially. Fourth, evaluate whether the £1,000 property allowance beats your actual documented expenses. It usually doesn't, but sometimes it does, and it eliminates record-keeping burdens. Fifth, examine income splitting opportunities if you're married or in civil partnership. These aren't strategies for everyone, but they're worth exploring. Finally, prepare actively for what's arriving. The Renters' Rights Act in May 2026 will change how you operate. Making tax digital from April 2026 will change how you file. Potential EPC requirements will reshape your upgrade costs. These aren't distant possibilities, they're months away. The 2.86 million landlords operating now won't all remain in 5 years. Thousands are leaving. Properties are exiting the sector. But if you're staying, if you've committed to this as part of your retirement planning or income strategy, then squeezing every legitimate tax saving and every operational efficiency matters directly to whether you remain competitive or exit like so many others are doing. Control your costs, maximize your deductions, and understand your tax position. That's how you stay in the game. If you found this breakdown helpful, don't forget to hit that like button and subscribe to Property Brief UK for more essential updates on the UK property market. We cover everything from legislation changes and market trends to practical advice for tenants, landlords, and investors. Ring the notification bell so you never miss an update that could affect your property decisions. Thanks for watching, and we'll see you in the next one.